Hello financial fans, welcome back to another stock analysis. Today we'll be covering PepsiCo stock ticker PEP. PepsiCo is a multinational food and beverage corporation that operates in over 200 countries worldwide. The company is known for its iconic brands such as Pepsi, Gatorade, Tropicana, Lay's, Doritos, Quaker Oats, and more. PepsiCo operates in two main segments, Frito-Lay North America and PepsiCo Beverages North America. Frito-Lay North America includes brands such as Lay's, Doritos, Cheetos, Tostitos, and more. PepsiCo Beverages North America includes brands such as Pepsi, Mountain Dew, Gatorade, Tropicana, and more. In addition to these two main segments, PepsiCo also operates internationally and has a presence in Europe, Asia, Africa, and the Middle East. The company's international operations include both food and beverage products, and their products are sold under a variety of local brands as well as global brands such as Pepsi and Lay's. PepsiCo's overall mission is to be the world's leading consumer products company focused on convenient foods and beverages. The company is committed to providing a wide range of products that are both enjoyable and nutritious, while also striving to minimize their environmental impact and support the communities in which they operate. The company is currently sitting at a market cap of $253.9 billion, and their revenue in 2022 was sitting at $86.4 billion, and the dividend yield is sitting at a nice 2.5%. 32% of the revenue comes from North America beverages, 25% from Frito-Lay North America, 10% from Latin America, 16% from Europe, 8% from Asia, Middle East and South Asia, 6% from Asia Pacific, China and Australia, and the remaining 3% from Quaker Foods North America. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company, and we'll be using a standard margin of safety of 25%. That can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has actually gone down over the years, growing from almost $9.9 billion in 2013 all the way to almost $12 billion in 2021, but sinking down to $7.4 billion in 2022. This gives them a negative EBIT growth of minus 2.1%, which is a 5% increase in the margin of safety. Margin has gone down as well, similar to the EBIT. It has gone from almost 15% in 2013 to staying around 15% in 2021, but sinking down to 8.5% in 2022. The average margin decline here is 4.7%, which is another 5% increase in the margin of safety. Next to ratios at dividend growth and the payout ratio. Dividends have gone up over the years, going from $2.62 a share in 2014 to $5.06 a share in 2023. It's also noteworthy that they're a dividend king at the moment. This gives them an annual dividend growth average of 7.6%, which is a 5% deduction in the margin of safety. This, together with the payout ratio, sitting at a nice 71%, meaning no change in the margin of safety. The final two ratios that we'll be looking at are debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And for PepsiCo, this is almost 4 years. In this case, a 389% debt to EBITDA ratio, which is a 5% increase in the margin of safety. The return on invested capital for PepsiCo is looking very solid, sitting at 12.23%, indicating that the management is very effective at allocating capital, which awards them with a 5% deduction in the margin of safety on this metric. Let's go look at the valuation models next to determine the intrinsic value of PepsiCo. First valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of PepsiCo going from 2013 to 2022. The average growth was actually a decline in free cash flow of 1.3% on average. But I'm expecting a 10-year expected growth rate in their future free cash flows of 5%, seeing as it went down a lot in 2022. I'm expecting it to grow again. And with this percentage, we'll determine the future free cash flow for PepsiCo and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 8%. This gives them a sum of free cash flow of $132.5 billion. And to get an equity value, we have to add the cash and equivalents and subtract debt, leaving us with an equity value of $103.8 billion. And all we have to do to get an intrinsic value of this model is to then divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $75.23, which is a massive 59.2% downside out of this model. The next model that we'll be using is the dividend discount model. I've imported the dividend payouts of PepsiCo for the past 5 years, and on average, this has grown by 7.29%. And I'm projecting expected growth rate in the future dividends of 6%. I will be using a discount rate of 8% in this valuation as well, which gives them a dividend discount model price per share of $278.18, which is a 45.47% upside of this model. The third model that we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that PepsiCo is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds. And looking at all of these metrics, we get a fair value of $96.30, which is a 47.77% downside out of this model. The fourth model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to PepsiCo, look at their stock price and their earnings per share. This way, we could determine the average PE multiple in the industry, which in this case is sitting at 37.11. All we have to do to get a fair value of this model is to then multiply it by the earnings per share that PepsiCo is generating, which gives them a multiple valuation price per share of $238.25, which is a 29.23% upside out of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that the company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. I've imported the dividend yield of the past 5 years. On an average, this one has been sitting at 2.93%, while the current yield is sitting at 2.61%. This means it's currently overvalued on this metric. Doing the same for the PE ratio of the past 5 years has been sitting at 21.87, while the current PE ratio is sitting at 27.45. Indicating that it's once again overvalued on this metric as well, which gives them a fair value of $155.60 out of this model, which is a 15.6% downside out of this model. If you want access to all of the valuation models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $166.71. Without a margin of safety, we would already get a downside of 9.5%, but we have determined a margin of safety earlier, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, 5% for the EBIT growth, and 5% for the margin growth, and deducting by 5% for the return on invested capital and dividend growth, leaving us with a 30% margin of safety. Applying this margin of safety, we get a fair value of $116.70, and with the current price of $184.36, we get a downside of 36.7%, indicating that's currently a sell. But keep in mind that it's a dividend king, and you're likely to pay a premium to own this stock. If there are any other companies that you would like to see me cover on this channel, please let me know in the comments. And thanks for watching.